There is a specific sentence that almost everyone who has not started investing yet has said to themselves. It sounds responsible. It sounds like caution. It sounds like the kind of thing a smart person says before doing something important. The sentence is, "I will start investing when I feel ready." Here is what the data says about that sentence. A 2025 study by Barclays found that the biggest single barrier stopping people from making their first investment was not a lack of money. It was decision paralysis, the inability to act out of fear of making the wrong choice. 44% said they lacked enough knowledge to start. 41% said they feared losing money. And the average person sat on that decision for 3.5 months before doing anything. Nearly 1 in 10 took over a year. Most never started at all. Feeling ready is not a financial strategy. It is a feeling. And feelings cost money. By the end of this video, I will show you the exact dollar figure the average person sacrifices by waiting just 5 years to start investing. It is not a small number. And it compounds every single year you keep waiting. The first reason people never feel ready is not laziness, and it is not ignorance. It is biology. The human brain evolved to treat uncertainty as a threat. For hundreds of thousands of years, uncertainty about food, shelter, and predators meant danger. That threat detection system is still running. And in modern life, it fires at stock market volatility the same way it would fire at a physical threat. Behavioral finance researchers call this loss aversion. The pain of losing money is psychologically twice as powerful as the pleasure of gaining the same amount. Losing $100 feels worse than winning $100 feels good, by a factor of 2. That is not a personal weakness. It is a documented feature of human psychology studied across decades of research. The result is that people avoid investing not because they have calculated the risk accurately, but because the downside feels unbearable even when the actual probability of permanent loss in a diversified long-term portfolio is extremely low. Your brain is running a survival algorithm in a context that does not require survival-level caution. Understanding that does not eliminate the feeling, but naming it is the first step to not letting it make financial decisions for you. The market timing trap. The second reason people never feel ready is the belief that there is a right time to start, and that they have not found it yet. The market is too high right now. There might be a correction coming. I will wait until things settle down. Every version of that reasoning sounds logical. Every version of it costs money. Here is what the data actually shows. Since 1957, the S&P 500 has hit new record highs approximately 18 times per year, according to BlackRock's Q3 2025 Equity Market Outlook. Record highs are not a warning sign. They are the historical baseline, or near its all-time high. Because over time, it trends up. Waiting for a pullback to enter means waiting while the market does what it has done for a century. Continue higher, interrupted by corrections that are impossible to predict and recover from faster than most people expect. If you want money content built on real data, not opinion, not prediction, subscribe. One new video every week. The cost of missing the best days. JP Morgan tracked S&P 500 performance from 2003 to 2023 and found that an investor who stayed fully invested earned 9.7% annually. An investor who missed the market's 30 best days over that same period saw their returns reduced by over 80%. Those 30 days, spread across 20 years, are impossible to predict in advance. And 78% of the market's best single-day gains over the past 30 years occurred either during a bear market or in the first 2 months of a bull market recovery, according to Hartford Funds research published in 2025. The investor waiting on the sidelines for safety missed every single one of them. The third reason is the one that feels most virtuous. I need to learn more before I start. And there is truth in it. You should understand what you are investing in. But for most people, this does not lead to investing. It leads to an infinite research loop. One more book, one more podcast, one more YouTube video, one more quarter of watching the market before committing. The Barclays 2025 study found that 44% of non-investors cited lack of knowledge as their main barrier. But the research on actual investing outcomes tells a different story. A 2024 Dalbar study found the average equity investor earned 5.5% annually over 20 years, while the S&P 500 returned 9.9% over the same period. The gap was not caused by ignorance. It was caused by behavior, specifically by trying to time entries and exits based on the belief that more information would reveal the perfect moment. More knowledge did not close the gap. Discipline did. The investor who bought a low-cost S&P 500 index fund in 2005 and held it without a single active decision outperformed the average investor who spent 2 decades researching, optimizing, and timing. The S&P 500 has delivered an average annual return of approximately 10% over nearly 70 years of data, according to NYU Stern's historical records. You do not need to understand every company in the index to own it. You need to buy it and leave it alone. The fourth reason is the most dangerous because it feels responsible. Keeping money in a savings account feels safe. It is familiar. It does not go down. The problem is that inflation erodes the purchasing power of cash, whether you act or not. Holding cash in a savings account earning 1 to 2% during a period when inflation averages 3% or more means losing purchasing power every single year, silently, without a red number on a screen. A savings account does not feel like a loss, but the math records it as one. The S&P 500 has historically returned approximately 10% annually before inflation, per NYU Stern data going back to 1928. A $10,000 investment growing at 10% annually for 30 years becomes $174,000. The same $10,000 sitting in cash at 2% becomes $18,000 over the same period. The gap between those two outcomes, $156,000, is the silent cost of waiting. Most people never see it displayed this clearly. That is why they keep waiting. Move 1. Start smaller than you think is worth it. The cure for never feeling ready is not more preparation. It is a smaller first step. Open a registered account, a TFSA or RRSP in Canada, a Roth IRA or 401k in the United States. Buy $50 of a broad index fund, VOO, VTI, XEQT in Canada. The specific amount is almost irrelevant. What the action does is break the identity of being a person who does not invest. Once you own it, the psychology flips. The fear of starting is replaced by the experience of being in the market and watching it behave exactly as the data said it would. Move 2. Automate and remove the decision. The second move is to remove the decision entirely. Set up a recurring monthly purchase, any amount, on the same day every month. This is called dollar cost averaging. You buy more shares when the price is low and fewer when the price is high without thinking about it. You eliminate the question of when is the right time because the answer is always the same, the first of the month. A 2025 Charles Schwab survey found that investors using long-term automated strategies reported significantly lower stress than those trying to time the market. Remove the decision. Remove the stress. Keep the returns. Move 3. Calculate the actual cost of waiting 1 more year. The final move is to make the cost of inaction concrete. Take the amount you would invest. Assume a 10% annual return, the S&P 500 historical average. Every year you wait, you lose that year's compounding permanently. It does not catch up. A 25-year-old who invests $500 per month from age 25 to 65 accumulates approximately $2.6 million at 10% annual return. A 30-year-old who starts the same plan 5 years later accumulates approximately $1.6 million. The 5-year delay costs $1 million. That is the number. That is what waiting until you feel ready actually costs. I told you at the start I would show you the exact dollar amount the average person sacrifices by waiting just 5 years to start investing. Here it is, $500 per month, starting at 25 versus 30, assuming the S&P 500 historical average return of 10% annually, $1 million in lost compounding. Not lost in a crash, not lost to bad decisions, lost to waiting, lost to feeling like the timing was not quite right, lost to the research loop that never ended, lost to the savings account that felt safe while inflation quietly worked in the opposite direction. You will never feel 100% ready. Nobody does. Readiness is not a feeling that arrives before you start. It is a feeling that arrives after. The data on this is unambiguous. Time in the market beats timing the market. The best day to start was 10 years ago. The second best day is today, not next month, not after the next earnings report, not after you finish one more course. Today, my question for the comments: what has kept you from starting, or what finally made you start? Drop it below. I read every response. And if this is the video that finally moves someone off the sideline, subscribe. One data-backed money video every single week.